Cryptocurrency trading is a fast-paced and volatile world. Traders are always looking for an edge to maximize their profits. This is where breakout trading comes in. A breakout trade occurs when the price of a cryptocurrency breaks out of a defined trading range. This range is typically characterized by a period of consolidation, where the price moves sideways. Breakouts signal a potential shift in momentum and the start of a new trend. Traders watch for breakouts because they offer the opportunity to enter trades early in a potential price surge. These early entries can lead to significant gains, especially in the volatile cryptocurrency market. Understanding and identifying breakout points is crucial for traders aiming to capitalize on these price movements. Leverage is a tool that allows traders to amplify their trading positions and potential profits. When used correctly, leverage can significantly increase returns from successful breakout trades. The core strategy we will discuss involves starting with 1x leverage. As each breakout is confirmed, the leverage is doubled. For example, a trader might start with 1x leverage. If the trade moves favorably, they would then increase to 2x leverage at the next confirmed breakout. This process of doubling down continues with subsequent breakouts 4x, 8x, and so on. While this strategy can lead to substantial profits, it is crucial to remember that leverage is a double-edged sword. It amplifies both profits and losses. Therefore, proper risk management is paramount when using leverage in breakout trading. Trading with leverage requires a disciplined approach to risk management. This is where stop-loss orders become essential. A stop-loss order is an automated instruction that sells your cryptocurrency when the price falls to a predetermined level. This level is set below your entry point and acts as a safety net, limiting potential losses. When using the leverage strategy outlined earlier, stop-loss placement is critical. The stop-loss is typically placed just below the previous breakout point. This ensures that if the breakout fails and the price reverses, the trade is automatically closed with a minimal loss. By utilizing stop-loss orders, traders can confidently leverage their positions, knowing that their risk is defined and managed. Section 4. Illustrating the power of leveraged breakouts. A practical example. Let's imagine a scenario where Bitcoin is trading within a range of $20,000 to $21,000. A trader identifies a breakout above $21,000 and enters a long position with 1x leverage. The price continues to rise, breaking through $22,000. The trader then increases their leverage to 2x. Bitcoin breaks above $23,000, prompting the trader to increase their leverage to 4x. This process can continue with the trader doubling their leverage with each successful breakout. Of course, a stop-loss order would be placed below each breakout point to limit potential losses. This example illustrates how quickly profits can compound using this strategy. However, it's crucial to remember that this is a simplified example. Real-world trading involves many other factors and risks. Educational resources like Sniper School offer comprehensive training on these strategies. However, it's crucial to remember that all leveraged trading carries inherent risks. Past performance is not indicative of future results. Always manage your risk responsibly.